Japanese government bonds are facing pressure on both the monetary and fiscal fronts. Core consumer inflation in Japan's capital Tokyo remains elevated, with the ex-fresh food and fuel measure rising 3% in August from a year earlier. That was down just a tenth on the level seen in July. And in what was a major surprise to markets, the national unemployment rate fell to 2.3% in July, hitting levels not seen since December of 2019. Taken together, these point to persistent inflationary pressures, keeping the Bank of Japan on track to lift short-term rates from 0.5%. Traders see roughly a 2 in 3 chance of another 25 basis point hike by year end, with a full move priced by March. That continues to pressure JGB prices across the entire curve. Benchmark 10-year yields have already risen above 1.6%, hitting levels that have not been seen since October of 2008, with fiscal concerns exacerbating the scale of the move. Japan's finance ministry plans to request a record 32.4 trillion yen for debt servicing next year. High interest costs and rising yields are expected to push debt servicing expenses to levels not seen since the GFC. Fiscal pressures are also being fueled by political moves. The Japanese government plans to scrap a decades-old gasoline surcharge, which will cut around 1.5 trillion yen from annual revenues. Japan's Finance Minister Kato has flagged market concerns and stressed that debt management and fiscal health remain key priorities for the government. The ministry is also rumoured to have consulted primary dealers on potentially reducing ultra-long-term bond issuance, presumably in an attempt to limit upside in yields by restricting supply. But the backup in Japanese yields matters for more than just Japan. Rising JGB yields are adding to pressure on global long-term rates, with France and the UK showing similar strains over recent weeks. Interestingly, US long bond yields have been trending lower over recent months, unlike what's been seen in other G8 nations. But how long that can last if borrowing costs rise elsewhere remains unclear, especially if US fiscal concerns remain. For a global economy built on decades of low rates, it's a risk for interest rate sensitive sectors and for asset valuations.